G'day, Scuddy here. Euro US looks increasingly vulnerable to a bearish breakdown, and the reason is very simple. The gap between the US and Eurozone economies keeps getting bigger. Just take a look at the latest PMI data. In the US, services activity accelerated again in May, with new orders and inventories jumping sharply. Businesses are still spending, demand remains solid, and the AI infrastructure boom continues to provide a huge tailwind for economic growth. Meanwhile, over in Europe, business activity remains stuck in contractionary territory. In fact, S&P Global says current PMI readings are consistent with the Eurozone economy shrinking in the June quarter. Now have a look at Citi's economic surprise indices, which measure whether economic data is beating or missing expectations. The jaws between the US, shown in red, and Eurozone in blue continues to widen. US data keeps outperforming forecasts, while European data continues to disappoint, and there's a good reason for it. See, the US remains one of the world's energy haves, benefiting from abundant domestic supply and a massive AI investment boom. Spending plans from the big tech hyperscalers now exceed 2 percentage points of US GDP, an extraordinary amount that would have only seemed unimaginable only a few years ago. In contrast, Europe sits on the other side of the ledger. It's more exposed to imported energy costs and was already struggling to generate meaningful economic momentum before the latest jump in fuel prices hit. What's interesting is that markets have a full ECB rate hike priced later this month, and nearly 3 hikes priced by April of next year. Ordinarily, that would be supportive for the euro. But Euro US just isn't responding. Instead, investors appear far more interested in growth, energy security, and economic performance. Hiking into an energy-driven supply shock risks looking a lot like Trichet 2.0 from 2011, doing very little to curb inflation, but potentially a lot to smash activity. Looking at the daily chart, Euro US remains trapped beneath major moving averages and continues to test the lower boundary of a compression structure. Momentum indicators are starting to roll over, and if support gives way, bears may start eyeing a retest of the March swing low at 1.1412. For now, the economic jaws continue to widen, and that's a backdrop that continues to favour the US dollar over the euro. Best of luck with your trading. I'll catch you next time.